Hello, I'm Kim Warren, and in this slideshow, I'd like to explain why the field of strategy needs dynamics and indicate a little bit about what we actually mean by that. If we look at the answers you get from standard strategy tools that have been around for many years, they basically answer two or three main questions. The first is, where in an industry or a market should you try to compete so that you can get access to profitable opportunities? Then it explains something about how to compete in order to actually take a higher profitability than other people in the same sector. And recently, the field has moved on to start talking about business models, the way you put things together in order to capture value. And you'll find plenty on these topics and the various tools and methods around these topics in all the standard strategy textbooks. I happen to use Rob Grant's book, Contemporary Strategy Analysis, for this, but there are lots of books that cover the same kind of ground. So let's address that first question of where to compete. And the origins of this come from trying to understand the distribution of profitability amongst different firms in the same industry. So in this chart, you've got profitability bands for companies all operating in the same marketplace. And on the left, you can see we've got a couple of little companies who are actually unprofitable. And on the far right, you can see we've got one mid-sized company who's actually very profitable. And in the middle, we've got a mix of larger companies, medium companies, and smaller companies, making profitability in the range of 0 to 10%, 10 to 20%, 20 to 30%. So you've got the size of the different firms in the industry in those stacked bars. And you've got the profitability bands into which they happen to sit going along the bottom there. So this is a nice profitable industry where most of the industry activity is making between 10 and 30% return on invested capital. Now that contrasts with this rather less attractive low profitability industry where most of the activity is in the 0 to 10% return band, and quite a lot of companies are making losses and almost nobody is making really high returns. It turns out there's been lots of research on this, and different industries characteristically fit into a spectrum between these two extremes. So industries where profitability is quite high include pharmaceuticals, petroleum, food services. Industries that are at the low profitability end include airlines, where actually the whole industry has basically been hugely unprofitable for pretty much as long as the airline industry has existed. Entertainment and telecoms are other sectors where it's actually quite difficult to achieve very much in the way of good profitability rates. What causes these levels of profitability? Well, here is a standard industry analysis tool. And basically what we're wanting to understand is what is it pushes profitability down towards the 0 or negative end of the scale. And there are the 5 standard forces here. If we've got strong competitors, they come along and say, well, I can take your customers and profits away from you if I offer lower prices and better products which are more costly to produce. So they cut their profitability and you have to do the same in order to stay in the game. You will have your profit pushed down if customers have got plenty of choice and easy to switch, so they can say to you, look, I'm not going to buy your product unless you cut the price. Suppliers will take your profitability away if they control something important, so you've got to pay them higher prices for those scarce things that you need. If you are profitable, if the industry is profitable, new entrants have a look at that and say, hey, that looks pretty good, I'll have some of that, and they jump into the industry and compete away the profits. And if all that's not bad enough, then there's the danger of substitutes coming along saying, I don't care what you're offering, I can actually offer your customers an alternative thing completely from what you're doing and take your customers and profits away from this industry entirely. So things like online meetings are a substitute for going somewhere by train or by plane. And this is a very long established framework. Michael Porter came up with it in 1980, and it has really been a cornerstone of the strategy field for the last 30 odd years. The strategy implications from this are that you should choose an industry or a segment which is more like the one on the left. So go for a segment of the industry or the market where it is possible for high profitability rates to be achieved, and preferably not like one on the right hand side. If you can't do that, or even if you can, see if there are ways for you to manage those forces to get better than average profitability. That's a start on the kind of how to compete question. So that's just one example of answering the question of where to compete. If we think about how useful this is, well, it is somewhat true and it is somewhat useful. Those industries do have those characteristic profitability levels. And if you do understand that, then yes, you can make some choices about which industry segment to compete in. You can't go very far on it. It's not actually possible for American Airlines, say in the airline industry, to decide it would be much more successful if it was in the petroleum industry and start competing with Exxon. But nevertheless, there is some adaptation and some choices you can make on this basis. But it's a bit limited because the analysis really changes very little over years or decades. You get pretty much the same answer when you do this analysis of an industry year after year after year. So it doesn't tell you very much about what exactly to do on Monday morning. The second thing is that the choice that companies make very rarely changes either. As I said, American Airlines is hardly going to decide to throw in the towel in airlines and start up in petroleum. And Exxon equally is hardly going to throw in the towel and say, well, actually, I think Google is a really great place to be. I'll start up in the search engine industry. That's not the kind of thing that companies actually can do. So the choice rarely changes. And the other point about this is that even in those horribly difficult industries where it's very hard to achieve high rates of profitability, companies grow huge cash flows and become extremely profitable and attractive to their investors. Supermarket retailing is low margin, low return on invested capital typically, but there you've got people like Walmart and Tesco who grow huge profits, and even in airlines you've got companies like Southwest and Ryanair who manage to be extremely profitable in industries that kind of fail this kind of test. So maybe it's all about positioning then. Let's see if we can find a position in the industry that allows us to take that slightly darker blue position. In that case, we would like to be the bigger firm in the 20 to 30% profitability band rather than one of those to the left. And the value curve is one typical tool for answering this question. And what it basically does is you can see across the bottom of that right-hand chart, we've got the different things that might be important to customers, and the blue line shows how much customers value those different aspects of what we do. And we do pretty well because what we offer on the red line is generally rather better than what customers expect, and it's rather better certainly than the competitor who's offering the ratings on the grey line below that. So you design the value curve proposition to get better than average profitability, to get you into that place to the right hand side of that lower chart. And there's various sources for this, but Kim and Moborn in 1999 kind of crystallized this idea in their article in Harvard Business Review, Creating New Market Space. Once again, somewhat true and somewhat useful, but as with the industry positioning choice, this choice very rarely changes either. It very rarely changes even over decades. And the simple fact is, successful companies do not keep changing their minds about what they do. Amazon has been doing pretty much the same thing ever since the late 1990s. Skype has been doing the same thing. ExxonMobil has been doing the same thing. Toyota has been doing the same thing. This is simply not a choice that changes very often. So once again, it's not going to tell you anything much about kind of what to do on Monday morning to implement and deliver your strategy and success. The second point is that many competitors choose the same position. If we look at the low-fare airline industry, for example, 60 airlines started up between 2000 and 2007 in Europe in effectively the same position of low-fare airline services. 48 of those subsequently either went out of business or got taken over. Many competitors choose the same position. But in spite of that, performance differs by orders of magnitude between those that are successful in the same position and those that are unsuccessful. And by success here, we mean growth of cash flow. And the tool doesn't tell you very much at all about how to implement the strategy and how to grow those profits. So the hunt has been on for other explanations as to why some firms are more successful than others. And in recent years, we've looked at this idea of resources driving our ability to be more profitable. The field has kind of got a categorization of these resources, dividing them up into tangible things, financial, that's money, physical capacity, that kind of thing. Intangible resources like technology, reputation, and culture. And resources related to the people, their skills, their ability to collaborate and how motivated they are, and so on. And it is said that these things in combination give rise to superior capabilities to compete in the industry and once again get you to be more profitable than most of the other folk around you. And this is summarized quite nicely in a book by Jay Barney called Gaining and Sustaining Competitive Advantage. And this is known as the resource-based view of strategy and performance. This one is true and useful as well, but it suffers from some other difficulties. Most of the sources are pretty ambiguous about what exactly we mean by these resources and capabilities. And in particular, they make little attempt to quantify that in a way that management can actually get their hands on and understand what to do and how much with those resources and capabilities. As a result, there's no really clear link between those resources and capabilities and the actual performance that comes out. There's some indicative suggestions of a connection there, but it's very hard to turn those into something management can use to make that connection. And again, very little on how to implement strategy and grow profits with this. Most recently, there's been interest in this idea of business models, which brings together some of those other concepts into an integrated kind of view of things. And there's a pretty good book on this called Business Model Generation by Osterwalder, Pigneur, and a bunch of collaborators. And they too have the notion of a value proposition at the core of this business model canvas. And to that, they identify the key activities that the organisation needs, the key resources they need to put together, and whether you have to have partners to help you achieve your aims. On the customer side, they show ways of thinking about customer relationships and the channels by which you reach those customers, and also the important issue of segmentation of customers. Out of that drops the cost structure and the revenue streams of the business. And if that business model canvas is well put together in a strong and coherent way, then that will lead to business success. So business models, well, they too are somewhat useful. They have the advantage of kind of putting everything on the same page, and it's been widely used to challenge the way in which existing businesses operate, to find ways of doing things differently and therefore innovating the strategy. However, this choice too rarely changes. Once you've decided what this business model is, nothing much really should change over many, many years. Once again, many competitors may choose the same model as you do, and there's little too on how to implement the strategy from this or to deliver growth in profits. So what the answer we need, and that we're not getting from the existing strategy tools, is how to grow and sustain strong cash flows from a business over long periods of time. There may be other performance over time questions too, but this is a very central and typical one for business leaders and people who invest in businesses to be concerned about. And if growth of sustained strong cash flows is what you're interested in, the question arises, how do you get a mid to long-term profit and cash flow forecast out of current strategy tools? And none of the books or articles I've seen provide an answer to that question. So let's see if we can move from the question how to achieve superior profitability and find a way of getting to this answer that we need. And to do that, we need an example. And we start by asking the question, well, what does success look like? Well, here's an example of a struggling business. Back in 2000, it was achieving return on invested capital of 15%. For the next few years, it dropped to 12, 11, 10, 12, 10, and then down a little bit further towards 9% in 2009, big recession, real hit on return on invested capital, and then a recovery, but still only to 6%, 7% return on invested capital in the latest 2 years. But to understand the relationship with growth of profits and cash flow, we're going to have to slightly change the scale of this chart, which I'll just do right now. I'm going to squish this chart downwards and look at the absolute profit this company has delivered. And here's what happens when you do that. There is at the bottom of this chart the actual cash profit that corresponds to the case I just described. And you can see that started at something over 100 million euros per year back in 2000 and dropped to somewhere around 50 by the time you get to the end of the period. So that's the actual profit that this company would have achieved if it had not grown. The blue line shows the actual profit it did achieve, with profits racing up over 700 million. Yes, there was a bit of a reversal in 2009 in absolute profits, but then profits jumped again in 2011 and 2012. So is this an unsuccessful company? Well, probably not. This is Europe's leading low-fare airline, Ryanair. Their fall in return on invested capital is not unproblematic, but that's not the indicator of success. The indicator of success is that operating cash flow they've delivered. Without that growth, even if the company had sustained the same return on invested capital, that's the profit they would deliver, the same cash profit year after year over that period. And to make any significant improvement on that, if they'd improved their return on invested capital from 16 to 20%, well, that's the profit they would have achieved. So of all those options, which would investors have preferred? And it looks likely that they would have preferred the top line in that chart. And that's assuming that any of the dash lines would actually have been available. It's completely unfeasible that that airline could have grown its return on invested capital from 16 to 20%. Pretty unlikely it could have sustained even the 16% it started with. It's even debatable whether it could have remained positively profitable at all back at the scale it was back in 2000. Now, it's not quite as simple as this, because this is operating cash flow, and an awful lot of that operating cash flow has been ploughed back into buying more aircraft and opening up new airports and starting more routes. So the free cash flow that investors get their hands on is quite a lot less attractive than this. Nevertheless, this is a much more successful scenario than the return on invested capital chart would imply. So is this a struggling business? No, it's not. It's an extremely successful business. So that's their success to date. What do we want looking forward? Well, what we want looking forward is we want to, first of all, understand how we got to this point in 2012. We want to avoid the danger of those profits actually getting damaged and going away over the next few years, as shown in the red line. And we want to get a better future, shown by the green line, continued growth in profits and cash flow. Now, this is a financial objective for a commercial investor-owned business, but there are equivalent questions for non-business cases, albeit that they're pursuing different performance measures. Why did they get to where they are? Where are they likely going? And how can they get a better future? So that's the future we might prefer, that green trajectory there. To do that, we're going to actually have to implement the strategy over the next few years in the same way that we've been implementing it up to 2012. So here is the strategy on the left-hand side, who we're going to serve, with what and how, and here is the cash profit on the right-hand side. So the strategy is pretty clear and it hasn't changed much. Who are we going to serve? Cost-focused travellers. What are we going to serve them with? We're going to serve them with very low price, reliable travel to a wide range of destinations and various other things. How are we going to do it? We're going to go to low or zero cost airports, and we're going to use the newest, most efficient aircraft and various other operational choices that are made about how exactly to deliver this. But between that strategy and that performance, we've actually got to have a time phase action plan. There's a whole ton of decisions that this company has to make all the time. What fare are we going to charge on every route? What routes are we going to add? What routes are we going to cut? What frequency of services are we going to offer? Not just in general, every single route you've got to make that choice. Which cities are we going to serve? Which cities are we going to stop serving? From which new airports? How many aircraft are we going to buy? How many aircraft are we going to sell? What type of aircraft? What size of aircraft? How many people are we going to hire? Where are we going to hire them relative to the airports from which we operate? And so on and so on and so on. Now that's a long, long list of detailed decisions that this company has to make to translate that very broad, high-level statement of their strategy position into the actual profit growth on the right-hand side of that page. So what management needs from strategy is to get from that statement to a time phase action plan, and from there to a view of what's going to happen to our cash flow going forward. Strictly speaking, free cash flow after reinvesting for growth. Now, if strategy can't answer that question, what does management do? Well, they ask finance. And because finance don't have our grasp of strategy principles, then you get some quite dangerous results from this. The dangers of finance-driven strategy, by which we mean, quotes, keep margins up, keep costs tight, and raise profitability. The first danger is that that philosophy strangles business development. It's very easy to explain. Imagine you've got a sales force of 10 people who are just enough to call on all your current customers, and those sales force account for 5% of your turnover. So finance says 5% of turnover, that's all we can afford to spend on the sales force. That's it. Your sales force can only carry on calling on those existing customers. What if there's 10 times as many customers out there who you could get at if you doubled the sales force? So instead of having 10 salespeople, you had 20. Instead of spending 5% of revenue on your sales force, you'd be spending 10. Well, that allows you to develop the business. It hits profitability in the short term, but it allows you to grow the business. So this kind of control strangles business development. The second danger is that it exposes business to more risk. If you are operating a business that is really as lean as it can possibly be and something goes wrong, you have got no resources to call on to respond to those problems, whether those problems come from general recession or some particular attack by a competitor or whatever it may be. So yes, we need to address financial results, but we've got to do it in a way that connects the strategy to those financial results. Now, one pretty good attempt at this has been made with the balanced scorecard and strategy maps concepts. And in essence, here's how they work. You have the vision and strategy statement for the organization at the center of this picture. And at the top, yes, you do have the financial perspective. If we succeed in implementing our strategy, how will we look to our shareholders? What will happen to dividends and the stock price? That will only happen if, on the left-hand side, we do what we need to do to look attractive to customers so they buy from us. That will only be achieved if we have efficient and effective internal processes. What have we got to be good at doing in order to satisfy those customers? And to move forward, because things change, we need an organization that's capable of learning and growth. Our organization has to learn to improve what it does continually over time. So using balanced scorecards and strategy maps based on those principles, we're making a start on answering this question of how to improve performance over time. And there are these two good books from Kaplan Norton explain all about that. Balanced scorecards and strategy maps then are definitely useful. They capture the financial impact of non-financial factors, so they protect us a little bit against those serious risks of strategy being driven entirely by financial measures. They definitely help to implement new strategies. They focus on the processes by which strategy gets done, and they perform a very useful function in aligning the organisation on the overall goals that it's trying to achieve. Furthermore, and this is really important, they, in both of those books, Kaplan and Norton, recognise the importance of understanding that the business is a working system. Unlike the previous strategy tools we've had, which regard a business as a kind of checklist of things that you have to have, this actually does recognise that you're trying to operate a working system with interdependencies going on. These tools too have some weaknesses. First of all, they miss out important external factors. They take no account of what competitors are up to, for example. And there are only very limited connections back to proven strategy principles. So there's a lack of underlying rigor to it, which means that you're very reliant on the judgment of the people who happen to be taking part in putting the scorecards together. Nevertheless, these have made a huge impact on helping organizations implement their strategies better. If we're going to go further than that and really reconnect with the interests of managers and what investors want out of a business, what we really need to think about is what actually is the value of strategy. And the value of a business and the value of its strategy has been very well established in the finance field since at least the 1970s. The value of a business and its strategy is the present value of discounted future cash flows. And there are endless sources that will explain all about this. A particularly good one is the book by Tim Collar and colleagues at McKinsey entitled Valuation. And that explains this issue very clearly indeed. Now, although this is not the focus for non-business cases, they too must still be cash flow viable. If you're operating a voluntary organization or if you're running a public service, you've still got to have a viable cash flow position. But in those cases, you've got aims to improve other performance outcomes. But those too are improvements that happen over time. The bottom line for strategy is that we've really got to engage with finance and start talking some of their language. We've got to get from the strategy through the implementation plan to the financial results that come out of the strategy. And the questions that we have to answer are, first of all, why have we got to this point in time? Secondly, where might performance go? And thirdly, how are we going to improve it to make sure a strong performance going out into the future, as we saw with the Ryanair example? Now that is what the Strategy Dynamics toolset actually answers. And it answers it for any kind of organization or any part of any organization. It can be used for putting together a whole plan that you live with quarter after quarter, year after year, albeit with adaptations as things change, or it can be used to address a particular issue or a particular initiative, fighting off a competitor, entering a new market, making an acquisition or whatever. And it does this continually over time as things change. So it does make the connection to the implementation that delivers that performance that you're after. So thank you for watching this brief slideshow. There's plenty more at strategydynamics.com, and you will find there that our online course is now available with lots and lots of working frameworks, working models, and materials and worksheets for you to work with.